if you needed to recalibrate the Basel system, do you think it would be easy to get the Americans and the Chinese to agree to it? I think it probably would not. So I think we are vulnerable in that sense, in that the regulatory networks I don't think are as strong as they used to be. So what would the world's economic system sort of look like if there was an e-euro and maybe an e-pound, maybe an e-sing dollar, but no e-dollar?
So Harvard Davis, I'm very thrilled to have this chat with you, especially today, at a time when the entire universe of regulation and the architecture of effective regulation is up for question again. It was up for question when you were chairman of the FSA, the Financial Services Authority. And I think last year in December, there was this move called the Edinburgh meeting.
Edinburgh reform.
So it's come up for review. And then you have, in the U.S., Silicon Valley Bank, Signature Bank, First Republic, and all of that. Maybe just top of mind. What's different about regulation today from what it was in your time?
Well, the most significant difference is capital. That banks have now probably 3 to 4 times as much common equity capital backing as they had in the run-up to the big financial crisis. And at the time, the regulators thought, and I was part of this at the time, that as long as it was possible for a bank to raise new capital when it needed it, then a relatively small capital cushion was appropriate and was suitably safe. Now, we learnt in the big financial crisis, 2008-9, that wasn't right, and that you could burn through that capital buffer quite quickly in circumstances where all prices of assets were falling at the same time. So property prices were falling, equity prices were falling, and banks could quite quickly become insolvent. So the big lesson learnt then was that banks needed a larger capital buffer. So now, typically, it's something like 12 to 14% in most places, a bit less in the US, a bit more in Europe. We operate as a bank between 13 and 14% capital. And my own view is that that is appropriate, and that it does impose some costs on banks, but it does mean that you can cope with a relatively volatile economy, which we have had. And so it's quite notable that under COVID, which was a pretty big shock to the economy, banks didn't fall over. Basel I, 1984, the asset was hardcore mortgages sitting on the balance sheet. By the time you reach 2008, it's ephemeral assets, it's securities, it's derivatives of derivatives, and then by the time you reach 2023, you're looking at the impact of digital on everything about the banking industry. How much capital is enough capital, or is it time to start looking for a different model altogether? Well, you're right in your assessment of the difference between pre-financial crisis and the financial crisis. I'm not quite sure that the very fact that assets are digital or are traded in a digital way makes their risk characteristics any different. It might do, but it might not. I don't think that the method with which they are constructed and traded necessarily makes any difference. It's about the underlying asset that is important. So I think if we keep to a capital regime, then I think we've got an appropriately calibrated capital regime. There's quite a lot of analysis as to how much crisis you save, if you like, by adding more capital, because clearly having more capital imposes a cost. It means that credit is more expensive, so it imposes a cost on the economy, and it's a bit like an insurance premium. You you want to ensure that if there's a catastrophe, for most purposes, you're insured. Now, we all know that there are certain types of thing you can't really insure against. If the whole world ends and, the whole of Singapore is blown away, I mean, insurance is not fantastically useful to you. So my own view is that the big attention, or the main attention of regulators now should be focused on the non-bank financial institutions and whether some of them are engaged in maturity transformation in such a way that if they failed, they could cause ripples across the whole financial system in the way that banks clearly do if they fail. I think what you need to have is a closely networked regulatory system to match the closely networked financial system. Now, we were moving towards that, I think, after the last financial crisis. There was a sense in 2009 and 10 that every country said, we're all in this together. China had seen that their markets could be destabilized by something going on in the US, or indeed something going on in the UK actually destabilized Chinese markets for a while. And so there was a strong sense of coming together, saying, look, we're all in this together. We have to agree some common rules and we have to follow them and we have to police each other and do peer reviews, etc. And there was a moment when you felt quite optimistic about this. That's less true today, I think. You can just observe the geopolitics is such that if you needed to recalibrate the Basel system, do you think it would be easy to get the Americans and the Chinese to agree to it? I think it probably would not. So I think we are vulnerable in that sense, in that the regulatory networks, I don't think, are as strong as they used to be.
And it appears that the Americans are changing the rules on themselves. Deposit insurance was meant to work, and they threw it out right out the window and put in taxpayers protection on the system. And many countries around the world had just spent the last 20 years putting in place deposit insurance schemes, none of which were tested, and then when the moment of testing came, the Americans decided to insure everything at the taxpayer's cost. So, that in itself demonstrates that the responses will be whatever makes sense for the local markets eventually. There is no global coherent response mechanism or an agreement on what the global financial architecture should be.
There is, in fact, an association, a global association of deposit insurers, which is actually based in Basel alongside the BIS and the Basel Committee. But it's fair to say that it is by no means as coherent and uniform as Basel is. I mean, even Basel, people interpret it in slightly different ways in different places. There aren't really any global rules on deposit insurance, bluntly. So I'm afraid it is something where countries can choose their own way, and it is a very political thing. And I think that what happened here was that, to my surprise actually, quite a lot of smallish but growing tech companies had decided to sort of put all their eggs in one bank basket, which is not something you'd advise people to do. The political tolerance for telling these wonderful tech companies in Silicon Valley that they're going to have to wait for their money, the political tolerance for doing that was low. And therefore, they felt they had to step in to avoid a series of potential bankruptcies. And that has created a system which is not a very level playing field, because you've got much higher deposit protection now in the US, in effect, than you have in the European Union.
I mean, the line of questioning is really, is capital the final protection, of a banking business? Or is there another regime that would come into play? When you were chairman of FSA, there was this, you were characterized as being someone who wanted the industry to self-regulate in some ways.
Well, I never quite said self-regulation, actually. But I think that the difference between then and now is that at the time was that the best guarantee that a bank was secure was that it had a viable business model, such that if it did need more capital because it ran into some losses it didn't expect, then the market would be prepared to provide it. Not, obviously at an unattractive price perhaps for the shareholders, but nonetheless that it would be able to carry on going because its business model was viable. I think the fundamental problem with Credit Suisse really, and with some of the other banks have failed, is that people have looked at it and said, well, is this bank really a viable business in the long run? Because investors are not going to put money in if they don't think they're going to earn the cost of capital, cost of equity. I mean, why would you? So I think that's the issue. Have you got banks where they have a business model which doesn't offer the promise of returning more than the cost of equity in the long run? If you're in that position, then I think they are vulnerable, because any hit to capital can't be replenished. The market will just not give you any more. And that's, I think, the vulnerability of the present situation.
When Basel III came into effect, they did this thing, ARB, the Advanced Internal Ratings regime, and the standard internal ratings regime, it was mostly the Western banks that cheated on that by classifying their risk-weighted assets the lowest possible way possible. And Deutsche Bank did that, and I think several banks, particularly in Europe, and sometimes characterizing their risk-weighted assets as smaller than a lot of the Asian banks. Is there something that needs to be done or can be done to see an industry, being able to?
I mean, it's a complicated question, but first of all, I would contest the notion that people were cheating. I mean, I think there were different models that made different assumptions about variances and covariances, and that's really at the heart of it. But anyway, but you ask if there's a solution, and there is a solution, and the solution is currently being implemented,
which is
in Basel 3.1, which is that the regulators have said, look, no matter, you've got assets of X hundred billion,
200 billion,
whatever.
Yeah.
No matter what your internal model says, we are not going to accept a number that is less than 72.5% of that number. Okay. Then, because they say, we're just not going to be prepared to accept that you can discount more than that. So it's called the output floor. Okay, and that has been painfully negotiated between Americans and Europeans principally. Europeans did argue for a lower number, and for actually quite a decent reason, which is that, as you know, in the US is a more market-based capital system, and big US banks have less in the way of large loans to high-quality corporates. So the European banks have argued that, on average, their portfolio of corporate loans is a higher quality than the US portfolio of corporate loans, because the US banks are mainly lending to smaller companies. I mean, Apple doesn't. Why would a AAA rated corporate borrow from a single AA rated bank? It doesn't make any sense. So there has been a lively argument about how low the output flow should be, but eventually a compromise was reached, and it's 72.5%, because the regulators did agree that if you put the same portfolio of assets through different banks' models, you got different answers, and answers that they couldn't then really explain, because it wasn't clear why you got these different answers. So either the regulators went in and went through every assumption in every model and every loan, and tried to work out why these numbers were coming out differently, or they said, well, look, never mind, we'll just impose a floor. So they said, no matter how clever you are, you can't go below 72.5%. And that's where we are.
And then on top of that, there's this whole evolution of multiple models, being evolved. So if you take payments, for example, you've got central bank digital currencies, you've got stable coins, you've got crypto, you've got digital banking and all of that. How do you see how these things, these new technologies should be regulated? By which entity, and maybe for how long? Because sometimes an industry starts off one way and then it takes a different shape as it goes along.
Yeah, I mean, our system should allow the regulators to cope with this, because our system is based on the regulators having objectives, so the two principal ones being financial stability and consumer protection, and then they've also got to take into account other things like competition and competitiveness, etc. And I think that's a perfectly good framework. And so you have to say to yourself each time, well, can I satisfy myself that this entity is not going to cause trouble for other people because of the way in which it operates, either because its technology is flawed or it's got too little capital or whatever it might be. And also, can I satisfy myself that there's no reason why consumers should get a worse deal from this business model than from a more traditional business model? And if you can answer those two questions, then in principle, they should be allowed to be in business. Now, this is difficult, but on the whole, there's two approaches you can take, and you can see this around the world, where there are regulators who say, you tell us exactly what you want to do and how you want to do it, and then after it, you submit all that to us and we'll tell you no. So that's one. Yeah, and then you've got to go and guess which.
And then they look at your submission and they decide.
What was the reason for no?
Yeah.
And then, or you can say, well, we understand what you're trying to do. Come along and let's see if we can find a way where your objectives and our objectives can be aligned. Now that seems to me to be, in principle, an intelligent way of thinking about it. And there are people who've been in the sandbox and have come out with nothing, because there wasn't a way of meeting the regulatory requirements in a way that's compatible with the business model that they wanted to operate. So
I consider central bank digital currencies as regulatory activism of some kind. Not necessarily the regulatory agencies that you worked in, but if a central bank issues central bank digital currency, it then needs to take a position on supporting that at the expense of other things that are possible. And that seems to be the case in many countries where the central banks have come out to say that they are going to be issuing their central bank digital currencies, and what they end up doing is banning all kinds of other assets. Now, that's most likely not going to happen in the UK or the US, but this, it does introduce regulatory activism, as I call it.
Yeah, you'd hear that criticism more in the US than you would in Europe, I think. My concern about it is the financial stability concern, really, which is if you introduce a central bank digital currency which people can move into at the press of a button on their mobile phone, then there's a risk that at any sign of trouble in the banking system, people will say, well, what have I got to lose if I just shove all my money currently into my Bank of England account, and I'll then see whether this problem, and you could see a test case this year in March and April when one bank, American bank after another, was falling over, and then Credit Suisse fell over. People, rational people, not stupid people, might have just said, well, I'll shove my money in the Bank of England for the time being and see how this plays out. And that can be quite problematic.
That's regulators taking on a responsibility that they might have problems fulfilling.
Yes, well, they might say, I think, that this isn't the regulators exactly, that this is monetary policy.
Yeah.
It's so it isn't the PRA in our terms, it isn't the Prudential Regulatory Authority that would be issuing a central bank digital currency. The Bank of England, in its role of overseeing the monetary system and providing a stable
and therefore framework. The Bank of England needs to be regulated.
Well, then yes. It is unregulated, the Bank of England. a small unregulated bank in the City of London is one way of describing it, but it is nationalised, of course. But I think that there's a lot of argument to be had about the central bank digital currencies. I'm not quite sure I understand yet why they are needed. And there's also a very interesting question. I mean, it seems highly unlikely that the US will go in any
very close to that, despite the white papers being issued by the Treasury.
I mean, they're a long way away from any political agreement.
Right.
So what would the world's economic system sort of look like if there was an e-euro and maybe an e-pound, maybe an e-sing dollar, but no e-dollar?
The e-dollar people won't like it.
I mean,
for sure.
It's slightly odd. You can't quite see how this will shape up, really. So I think they should move a bit cautiously on this.
Right. Who?
The central banks
of the different countries.
Yes, of the different countries.
Yeah. Now, I mean, actually, underlining your remark is really global currency and all that, right? So, and that's a different conversation altogether. What about conduct in areas like salaries, like putting a cap on bank salaries in the UK and just in general?
Well, we have some serious constraints on bank pay at the moment. But the government is removing some of them because the bank bonus cap that was a European requirement, the Bank of England never agreed
subscribed to the idea
because it thought that it actually the result of it was to create more fixed pay and less variable pay,
which makes it worse.
Cap because, because
fixed costs.
Your fixed costs are higher. The big change that I personally think was correct, although it's complicated to administer, is the very large deferrals that we have. So we
push them out so that
if these profits that people were being paid on were illusory because they had taken on risks, it looked like a profit, but then in subsequent years,
someone else pays the bill later.
So we have up to 7-year deferrals of variable pay, which a lot of people don't like particularly.
Is that something that you pushed for?
Well, not at the time, because at the time there was no legislation to back any controls. It was not until the financial crisis that we had that. But personally, although, as I say, it's quite cumbersome to operate if you're a board, and the meetings of our remuneration committee are long and difficult, and trying to work out if something went wrong subsequently, whose fault it was that it went wrong, and should you claw back some of these bonuses that you haven't paid, is a very complicated exercise. But we're getting better at it, and the system does work. I think that is, to my mind, that is justifiable as a regulatory intervention. Whether it's justifiable just to have a cap, which is unrelated to profitability or anything else, I find that difficult. We don't intervene in other parts of the economy to say there must be a cap. Mm-hmm. And in the normal way, you'd say, well, look, if the government thinks that these salaries are too high, it's got a very good answer, which is it imposes a higher tax rate.
Right. And I'm thinking of a number of African countries, especially because they're getting their act together. The first frontier of regulations they put in place are on payments, and then they start looking at the institutions and so on. What advice would you give these institutions, or rather these countries, in terms of what their priorities should be, taking into account all the new innovations that are coming in place in banking today?
If you focus on the structural side, what sort of regulatory structure should you put in place? My own view, which is not shared by my government at this point, is that the experience of the big financial crisis, and indeed more recently, is that separating monetary policy from macroprudential policy is a mistake, and that because an interest rate or a rise in capital requirements can have similar effects, actually. You're tightening credit availability, or you're increasing credit cost, one way or the other way. So I personally would say the central bank should definitely do both monetary policy and overall financial stability, with the tool of macroprudential requirements being part of the financial stability policy. I then, however, would have a separate regulator for microprudential and for conduct, and personally I like them together, because I think that it's quite possible, especially in, say, insurance, but actually also in banking, to have a situation where the conduct regulator is pushing you to give better deals to the customer, better returns on their annuities, etc., saying it's unfair, you're discriminating, etc., where you might then be promising more than you've got capital for. And indeed, the big failure that I had to deal with when I was the regulator was of Equitable Life. I don't know if you remember that story, which was a very, very popular insurance company, and the regulators loved it to pieces because it was offering very generous returns to people, but actually it had promised about 110% of its capital, and eventually that didn't work and it became insolvent. And so I think that microprudential and conduct fit reasonably well together. And for a small country as well, or medium-sized countries you're talking about, where expertise and setting up authorities with genuine authority, with a reputation, etc., is difficult. There aren't that many people who are good at this stuff. And so I think if you set up lots of different little regulators, you're going to find it very difficult for them to impose themselves. So I would have a broad central bank, monetary and financial stability, and an FSA.
And appreciate the comment, because that sort of captured your ballpark idea of what regulation should be, and I take it that you also are taking into account the new stuff that are coming on board, and what regulators have to deal with, and that sort of puts in context your worldview. In some of the countries, there's also a need for different philosophies to coexist with each other alongside, and create that robust countervailing forces to hold a system together, and I think that different countries at different levels of enabling that. I'm thinking of countries that still insist on having single regulators handling a whole universe of issues, and that's not possible going forward. Thank you very much for this.
Thanks.
Cheers.